Are you looking to do a 1031 exchange in Hawaii? Have you ever wondered how a 1031 works? On today's episode, we're going to discover just that. What's happening? It's Hal Wilkerson with Hawaii Property Advisors on today's Hawaii Real Estate Roundup. I am super excited. Today, we are going to be talking about the topic of 1031 exchanges. And I'm so lucky to have Hawaii's premier expert on this subject, Tiffany Davies. And she's going to be joining me live. Let me bring her in here. There we are. Aloha, Tiffany. How are you?
Aloha. I'm doing well. Thank you.
Fantastic. Well, I appreciate you taking some time today to kind of go over this topic. You and I actually connected recently as I was doing some due diligence and some research for one of my clients specifically. And I thought, you know what, I need to get a little smarter on the 1031 topic anyway. And the best way for me to do that is whenever I create content around it. And so I thought, what a better way to do it than to have you come on. And so thank you for joining us. Now, tell us a little bit about your specific company that you're with and kind of big picture for you and what you do specifically in Hawaii.
Okay, well, I work for IPX 1031. IPX 1031 is a subsidiary company of Fidelity National Financial. So locally, our two brands are Fidelity National Title and Escrow and Title Guarantee. We are the largest provider of title and escrow insurance, and that makes us the most secure #1 exchange company nationwide. So my role is I'm the regional account executive. I cover the whole state. So we're doing a lot of 1031 exchanges here, but I'm helping people on the mainland and helping people locally 1031 exchange and accomplish their goals. I'm usually the first point of contact that you're going to speak to in an exchange. And then we have our team of exchange officers that are going to also be there to assist.
Gotcha. Okay. So IPX 1031, and you guys are part of First American
Fidelity.
Fidelity. Oh, excuse me. I'm so sorry. Fidelity. Yes.
But we love them all. We love them all.
And you do work with all
the
title.
We work with everybody. We do. We work with everyone.
Yeah, fantastic. Well, let's get right into it. I've got some banners here with our questions that we kind of talked about ahead of time. So the first thing let's talk about is sort of a 1031 exchange, sort of like the 101 class. What's a 1031 exchange?
Okay. So a 1031 exchange is a way to defer capital gains taxes on property that you've held for business or investment purposes. So, there's there's a lot of nuances to that. Of course, here in Hawaii, we have a lot of special properties that people create mixed use properties where they might live in a portion, rent out a portion. But for the most part, 1031 exchange is carved out specifically for people that are holding for business or investment purposes.
Okay, excellent.
And as long as you purchase property that is equal or greater in value to what you sold, and as long as that replacement property is considered like kind, then you can defer all of the capital gains taxes.
Gotcha. Now let me ask you about that real quick, and I'm going to expose my my lack of knowledge on the subject. So let's say you have $1 million property and you have $700,000 in debt on it, and you sell that property and you have a $300,000 cash out, right? After whatever net roughly. Okay. So you have $300,000 in equity to play with. Now, do you have to use that $300,000 to buy another property that is valued at $1,001,001, or can you use that $300,000 and just buy a $300,000 condo in Waikiki, for example?
No, that is not going to work. So, again, I am not a CPA. I'm not an attorney. I can't give specific tax guidance or advice. We always want our clients to check in with their CPAs before an exchange. But what we're typically doing, because we don't know the full tax picture of our clients, we're usually working with the net sales price. So we start with $1 million. We do get to minus off closing costs and commissions. If you're paying a realtor 6%, you get to add on another 1% for closing costs. That's about 7% off the top. But other than that, we're using that number as your reinvestment value. So we're using the net sales price. So it's sales price for sales price and debt for debt. We have to replace the value
That's
of
the statement. Okay. So, okay, that makes sense. So, so essentially they would have to take roughly a property that is going to have, they're going to have to leverage another 700,000 on their next property and maybe just a little bit more of equity. So if they do it a little bit less, it wouldn't qualify. Is that right?
Well, a partially deferred exchange is allowed. So,
Okay.
you know, the thing is there's a threshold with that. And so if you're buying down by too much, the exchange might not make sense. Sometimes it's better just to call it a day, pay your tax, and not get caught up in this exchange cycle. But otherwise, you know, if you're selling something for $1 million and then you're going to buy something for 900,000, I would say, you know, the exchange probably still makes sense if that property's been an investment property for you for quite a few years and you've been depreciating it and treating it as an investment property on your taxes. It's probably going to still make sense for you, as long as, again, you're treating the replacement property for business or investment purposes as well.
Excellent. Not a primary residence, no matter what.
That's right. Yep.
Yeah. Do 1031 exchanges, I know we've, like, specifically the client that we were talking about he's liquidating a business and he wants to move it into, you know, short-term rental kind of scenarios. Is it possible? Do you know if 1031 exchanges work in reverse? So, well, not, maybe that's not the right word, but basically you can sell a residential type property and move it into an investment in a non-real estate business as an investment. Do you know if that would be the similar type of 1031 or not? And this is obviously maybe not the best.
Yeah. So in 1031 exchange, you're selling the real estate underneath the business. So we're selling real estate underneath the business and we're acquiring real estate, like kind real estate moving forward. Okay. So as long as we're doing that, we're okay. We can't acquire a business or goods and services. We've got to acquire the actual real estate.
So it's absolutely tied only to the real estate, not to the business itself, just the real estate.
Correct.
Okay. Excellent. All right. Well, good. So that brings me to my next question. What kind of timelines are important to keep in mind when you're doing a 1031 exchange?
So the 1031 exchange timelines kick in at closing. So if we close escrow today, tomorrow's day one. That starts our clock. We have 45 days to identify replacement property and 180 days to close in total. Okay.
So when you say identify, we were talking a little bit about this before. So it doesn't mean you necessarily have to be in escrow. You don't have to have an accepted offer. You just have to say, this is my property at 123 Main Street. That's going to be the one. And you may not have an accepted offer until slightly after that 45 days, but as long as you've quote unquote identified it. Now, is there any reporting during that 45 days that has to be reported, or is it just at the end of your tax cycle that you're going to say, I closed on this property on June 1st, I identified something on July 31st, and we closed on it in, within 180 days after that? Is that
so? At closing, we send out an identification notice.
Okay.
That identification notice just needs to be back in our office by midnight, day 45.
Okay.
Another way to identify is us receiving a contract in our office from escrow, possibly. Okay. That also would be considered identification, but usually we're looking for clients to formally identify on the form that we provide by midnight of day 45 and no later.
I see. Okay. And so then you all will you will be part of the package that will be submitted to the CPA for filing of their taxes.
Right. So when the CPA goes to file taxes, usually they're looking for the closing statements of what we sold, the closing statements of what we purchased, and then our accounting statement for money in, money out, things like that. Mm-hmm.
Gotcha. Yeah. Okay.
Yep.
That makes sense. What happens if someone doesn't close on a property until 181 days after?
Then they are done. They failed their exchange, technically. There are no exceptions to the timelines unless the President of the United States puts his stamp on it. So that's the only time we see extensions. Other than that, it really doesn't matter what happens.
Really? Has that been has that ever happened where a president signed a 1031 exchange extension? Or
Yeah, it has. Believe it or not, during COVID, we saw some extensions. We see
really?
extensions when there's, wildfires, when there's big disasters. So
Okay.
anybody that's affected in either territory would be able to receive an extension, whether their property is located in the disaster zone or whether they are somehow affected by
Okay.
the crisis.
Okay.
They can sometimes receive extensions, but that's pretty much it.
Yeah. But
Otherwise,
but the
those
extension
timelines
has
are
to be the extension has to be signed by the president of the United States.
it does. It's a federally declared disaster.
Okay.
That's
Okay.
the
Wow.
only time we're going to see extensions to timelines.
Wow. That's impressive. So really, for all intents and purposes, there's no extensions. It's
There's no
181 days, and
extensions.
you are.
There's no extensions. The
Yeah.
only thing that is interesting in 1031 is that in the reverse fashion, you can sometimes venture outside of the timeline. So that's where we're purchasing first and then we're selling. So
Okay.
we can, sometimes, what is a reverse exchange, right?
That brings me to my next question. Yeah.
But our reverse exchanges, with 1031 exchange, there's something about staying within the safe harbor rules. So these are rules that the IRS lays out and says, if you follow these rules, we won't challenge your exchange. And then there's people that venture outside of those rules, right? More of the risk takers. But reverse exchange is where you're going to acquire your replacement property or properties first, and then you're going to take 180 days to sell. So there has been a case. So a lot of times in our industry, we look at things by case law or people that have been challenged by the tax court. And so there's been people that have ventured past the 180 days to sell, and their exchange hasn't been disallowed. And I think that was probably based on their intent, because their intent was to ultimately sell. But it does not work in the forward fashion, only in the non-safe harbor reverse exchange, which costs a lot of money to do.
I see. So essentially, they're not going to have any proceeds. They're just going to bank the benefits that they're going to receive from the future sale by basically acquiring a property.
They're going to usually, most of our reverse exchanges are all cash. So they're all cash purchases. So the client is somehow coming in with all the cash to make the purchase. That's the easiest way to do it. Lenders particularly don't love to lend on reverse exchanges. Sometimes if a client has deep pockets or a special banking connection, we see it done. But usually it's an all cash purchase. And so when you close escrow on what you're purchasing, what's happening is we're creating this entity or an LLC that's going to take title to this property, clients coming in to fund the LLC. And then when they get their property sold, they're paying themselves back or paying the bank back.
From the, through the LLC.
From the proceeds of what they
proceeds into the LLC and then
yes,
back.
Yes, correct.
Yeah, I see. Fascinating. So that's a reverse exchange. Are you seeing? So generally, that's for and obviously, I totally agree with you. All cash is going to be a lot easier across the board.
King. Yes.
Yeah, cash is king. So you don't have to deal with those pesky underwriters and appraisers and all that other fun stuff. Nobody likes those guys anyway.
Right.
Just kidding.
And everybody wants to come in looking like a cash buyer right now anyway. So it's a great way to utilize the means to acquire what you want to purchase first, and to eliminate some of the pressure with that 45-day deadline. Because right now in this market, it's tough to get out there and identify in 45 days or less. So we're seeing a lot of reverse exchanges right now.
Gotcha. I mean, it almost seems like that would, if you can financially swing it, it seems like that would be the no-brainer way to do it, because you eliminate that 45-day identification window, and you basically, at that point, you're just running with 180 days after you acquire the property that you need to then sell the others. And sounds like you said there's some case law that have supported even some extensions on that side of it a little bit more. Okay.
Right.
Okay, fascinating. So tell me about exchange papers. I may not even be saying the right word. Is that what they are? or what is it?
Yeah, that's not a bad word for it. I like to talk in layman's terms when we can, because I think it helps people understand that this process is probably not as daunting as it seems. But basically what it would actually be called is that those are our exchange documents. And so basically the process from beginning to end would be, if you told me today that you have an exchange that you want to set up with us, we would go ahead and get in touch with escrow first. From escrow, we would request the preliminary title report, the contract, and with that, we would draft exchange documents. So clients have to sign those exchange documents before the close of escrow occurs. That is imperative, right? And then number two, they can't receive any proceeds. So we get those exchange documents in place first, then we close escrow. Once escrow closes, funds leave escrow, they come to us, we hold them in a bank account in the interest of the client, and then we have to be instructed what to do with those funds, right? So then there's a second leg of the exchange where we're going to have another escrow involved, and that escrow is going to ask us how much money we're holding, and then client's going to come in with any additional funds that maybe need to come in or not.
Okay, gotcha. So the
and we've got to do that all within those timelines.
Yeah, and so the exchange papers are just the actual or documents that are essentially, it's sort of like, it's not obviously, it's part of the title process, but it's sort of its own separate little package.
It is. The exchange agreement is vital to the 1031 exchange. So the exchange agreement, along with the assignment that's included in those documents, is completely vital to the 1031 exchange.
Gotcha. Makes total sense. All right, good. Let's see here. Okay, let's talk about some gotchas.
Yes.
So what are some gotchas that people or investors are not, or they may be easy to miss or not be thinking about when they're going through this process?
Well, we've got people doing some crazy things out there in this market. So I would say we don't want to let any deposits go out of the exchange funds that are probably non-refundable. I would say that's probably not a good idea. We had a client do that recently, and we didn't know it, but he had let a non-refundable deposit go on leasehold property. So leasehold property can be considered, it is not considered like kind if it has less than 30 years remaining on the lease. And right. So unfortunately, because he had sold fee simple and there was less than 30 years remaining, that property that he was acquiring, that now he was tied into and absolutely had wanted to acquire because he had let so much money go towards it, was not going to be considered like kind. So that would just totally invalidate his whole exchange. We were able to figure it out and correct it for him, but it was a big problem. So that would be a big gotcha. Number one, not meeting the 45-day identification period, taking a vacation, getting stuck somewhere where, the great thing with IPX is that we do everything on DocuSign. So I've had clients sign in China, Australia, wherever they are traveling around, but missing a deadline would be number two. Number three, like we already kind of talked about, not understanding the basic rules of reinvestment.
Mm-hmm. Okay.
So that would be one, whatever we're selling for, we need to buy for. So I just like to use the sales price. It's the easiest way to think about it. We sell for $500,000. We've probably got to buy something for $500,000, unless you've got a savvy CPA that's going to give you those exact numbers, because you've made some major capital improvements or you're carrying forward losses. And then maybe, another one, there's a lot of them out there, but, those are probably the most important things, is making sure you reinvest all of the funds, making sure you get those exchange papers in place and allow for plenty of time before the exchange for us to get it set up so that you're not making a rash decision. We probably need about, I would say 2 weeks to a month to get the exchange set up if we're not rushing anything. That's plenty of time. Sometimes people choose to wait till the last minute. So the other thing that we always want our realtors to do is just add that 1031 exchange addendum, because that allows us to assign into the contract. So whether you do the exchange or not, add the exchange addendum, because then if we do want to get the exchange set up at the last minute, we've got that already done and you don't have to go back to your buyers to put them on notice.
Gotcha. Now, let me ask you this on the identification question. what if a buyer changes their mind on an identified property? Has that ever happened before?
That's a great question. Yes, it happens all the time. So we tell clients, and usually we kind of educate them before they've even started their exchange, right? So identification is a tricky topic. So you've got to pick a rule. Most commonly, especially if you're sticking around Hawaii, because our values are so high, people are using the 3-property rule, which states that I can identify 3 properties, any value. I've just got to close on 1 or more, can close on 2 or 3. But I've got to close on one of those, again, buying for equal or greater in value, like-kind property here that we're acquiring. If I do all that, I'm good. But let's say, what I usually tell clients, here's my word of advice to most clients. You get out there in this market, you get the exchange set up. The exchange is buying you basically for about $1,000 or less. It's buying you extra time to try to get out there and find a property in 45 days or to identify and really hone in on something. So a lot of times what clients are doing is they're getting out there in this market, making offers sometimes before they've even completely closed on what they're selling. And then they're working both escrows tandemly. We see a lot of our clients being successful that way. And then you have your clients that are more conservative, that want to wait until those funds come into the exchange to get out there and make offers. But if you get out there and you cannot find anything in the 45-day period, I tell people, then just don't identify anything. It's not looking good. Don't identify anything. Again, we talked about the DST. We'll go to that. We'll get to that. But that might be something to look at. Then you've got something identified that if properties 1 and 2 go away, you still can parlay into that DST. But if we get out there, it's all junk, and by day 45, we're totally stressed out. And I just say, don't identify anything. You can get your money back on day 46. If you do identify, and you get into something, it's all looking good, but then you call me on day 75, and it's all gone, haywire, and nothing that you identified you're going to be able to close on. Unfortunately, you have a failed exchange. You tried. And the other thing is, unfortunately, your funds have to be held through day 180 because that's part of the G6 restrictions that the IRS puts on us. So either you identify by day 45 and you call it a day, or you've got to hang on until day 181 for your funds.
So if you get all the way to that point and you haven't identified a property, your funds are held for like another 4 months, another 135 days past that 45 days.
Well, if you haven't identified, you're done. If you haven't identified by day 45, you're done at that point. You can get your funds back on day 45.
I mean, if you identify but aren't able to get it in an escrow, and it's just essentially becomes a failed exchange, you're is that interest bearing account at all? Like, are you guys?
It is. It is.
Okay.
Yep.
So
it's probably not much. Might be about as much to buy you a nice dinner.
Right.
It's not too much.
Yeah. Interesting. Okay. Well, that brings me. I have a couple of other questions off of what you said there. So overall, and I know an individual's tax scenario is there's a lot of variables that can go into that to answer this question, but generally, what kind of a capital gains tax rate are we looking for? I've always heard 40% is like the standard for this.
That's a great number to throw out there. That's a great number to throw out there. That's really conservative. And I think that gives people a really good idea of probably the max amount of taxes they're going to pay. It's a combined tax rate. So when we talk about capital gains tax, we're talking about the feds, the state, and depreciation recapture. So all of those things are being factored in. So it's a combined tax rate. And we tell people somewhere between 28 and 38% based on your income tax bracket.
Right, of course. But 40% captures all of that. So that's the good, easy rule of thumb. That's what I always use. Now, let me ask you this. Recaptured depreciation. So you threw out recaptured depreciation. That's obviously a complicated accounting principle. So they are effectively, if they've depreciated an asset, it's $1 million asset, and they've owned it for 3 years, and they've depreciated it 60% or whatever their accountant was able to do during those 3 years. And then they fail their exchange. And again, I know you're not an accountant, so I'm not going to look for specific.
You're not going to hold me.
Yeah, exactly. But I'm just curious, like, how would that, like, what was the number I said, 60%?
Well,
like,
I'll kind of throw out there what I use in our class a lot. When we're talking through these numbers, depreciation recapture is where the IRS comes back and recaps 25% of any depreciation that you've took for the course of however long you've owned it. So,
25%.
The example we use in our class is if you've owned a property, a $500,000 property for 10 years, and you have taken $37,000 in depreciation recapture over the course of 10 years, that's that little credit back that you get on your taxes every year for owning investment property. The IRS is going to come back and take 25% of that. 37,000. So they're going to come back in and take a portion back. It adds to, again, that combined tax rate, which you already covered with your 40%. So,
right.
Yep, that is, you can have gain due to appreciation in sales price, and you can have gain due to depreciation.
Yeah. So 25% is a flat rule. That's the capital, or that's the depreciation recapture rate is 25%. So irregardless of how long you've owned the property, whatever dollar amount you've depreciated it, they will effectively.
Well, you're only allowed to depreciate a residential property for 27 and a half years. Okay. So after that amount of time, and that's another rule for investors. If we've owned a property for that amount of time, you're not really getting any benefits. And that's a reason why people do exchanges.
Exactly. Yeah. So again, and this is all given in the event of a failed exchange, really. That's the whole idea, is to avoid all of that stuff. So,
correct.
Yeah. Gotcha. Okay. Multiple properties question. So you mentioned that you can do multiple properties. Am I understanding that if you sell, let's just say, again, keep the $1 million number to make it easy. You sell $1 million condo, and it was a rental condo, nice, beautiful ocean view, ocean front, whatever. And then you want to buy a couple of $500,000 ones, using the proceeds from that $1 million sale. That is, even those are two separate transactions, you can still do that.
Yes. There's no rule on how many relinquished properties you can sell or how many replacement properties you can acquire.
Okay. Now, when you say rule on relinquished property, but each individual property that you sell would have its own separate exchange. Is that right?
Right. But sometimes people want to sell two $250,000 condos and acquire something larger, right? Okay. Or they might want to sell off a lot of smaller assets and acquire one larger asset that's easier to manage.
Okay. Now, if the sale of those is on two separate days, how do they justify that? Is there
That's a great question. Yes. So the timeline kicks in from the first closing.
Okay.
So we've had people sell 6 condos at once, which can be very interesting.
Interesting.
But
okay.
Yes,
and then
even
they just do that
own...
all under the same exchange.
Yes. They have, if the timelines are too far out, then we've got to set up 2 separate, but usually we're putting them all under the same one.
Okay. Excellent. All right. And then the question that brought me to you was the leasehold. Now, one of the things that that you had mentioned to me with the leasehold is that obviously we already talked about the 30-year. As long as it has 30 years or more, that's the basic rule.
The basic rule is, as long as there's 30 years remaining on the lease, and we'd like to see options to extend. Those options to extend, will count as additional time.
And so if it's 17-year remaining, and it has 2 options that equal like 45 years or something like that,
then it works.
That can work.
Yeah, as long as those lease options, as long as it's being extended.
Okay, so the options don't necessarily have to be, obviously it's in the
years
future.
Remaining. We're looking for.
Yeah.
We want there to be 30 years remaining on the lease. That's really what you're looking for. And
okay.
because you're, and I always try to Not that you want people to completely avoid leasehold, because leasehold can be a great source of income for people, but you have to be really careful with it, because does it make sense if you ever for resale purposes later down the road?
Right. Yeah, absolutely. Okay, good. I'll ask you one more topic and then we'll wrap up. So we were talking a little bit about that failed exchange, or if you're getting close to that 45-day window and you haven't identified anything, then you mentioned a DST. That's an acronym for Delaware Statutory Trust. Talk to us a little bit about the Delaware Statutory Trust.
Yes. So DSTs, it's actually a part of, the tax code. So the IRS has carved out a section that says Delaware statutory trusts are considered like-kind property in a 1031 exchange. These properties are usually commercial grade properties. So they can be anything from an Amazon distribution center to a multifamily property, can be mini storage. There's a lot of different types of asset classes that you'll see with DSTs, but it could be medical office. So think like ESPN's headquarters, AT&T's headquarters. Those are Delaware statutory trust properties where you have multiple investors that have come together and own basically a portion, or almost like fractional interest, right? So you're basically you don't have control over the asset, because you do have to work with a sponsor. Like, here in the islands, we see Inland Real Estate is out here a lot. They're one of our preferred companies because they've been around a long time. They've never failed to pay an investor. They have a really good track record in this arena. But you have to do your due diligence when you're out there looking at DST's properties, because, there's a lot of folks out there that'll offer you a very nice return on your cash, but maybe they're, not as solid as a company. So those are all factors that come into this. But basically, you're getting a return on your investment. So a lot of them offer, 3 to 4.5% cash on cash return. And you're basically identifying this by day 45, and you can close relatively quickly. And then you're basically getting your mailbox money every month. You've got this asset that you don't really have to manage. It's really great for people that are looking to get out of the investment game. They're kind of maybe at the end of their investing career. They're done with the toilets, the tenants, the trash. They want something that's just a little bit easier to manage.
So the returns aren't as great, but they're much more stable.
Generally. That's a question in its own right. There's risk to everything. Sure. There's risk to everything. There's risk with DSTs. Again, you've got to do your due diligence. But what I've seen is sometimes, our cap rates aren't that great when you look at the numbers. We've done a lot of math with a lot of investors, and sometimes you can get, better with DST. So
are cap rates on multifamily in the islands?
Just depends on the property.
Of course.
Yeah. It's just not. It just depends on the property, but yeah, it's usually when you do the numbers, it's under 2.
Single digits, yeah, low single digits, right? On a lot of multifamily deals in the islands, I've looked at a handful of them. Interesting. And so a Delaware statutory trust. Now you mentioned the sponsor. So the sponsor is essentially they're the person that's putting and doing the legwork with the DST. And now, can you have a DST? And this might be a little too complicated, but can you have a DST that can be part of a REIT, a real estate investment trust, like as an investor, as a sole investor, or because I would just imagine
REITs are not the same. So REITs are completely different. They are not considered like-kind property in a 1031 exchange. So I would say, when you're looking at Delaware. Yeah.
I was being like the DST, like the sponsor of the DST, like what are the guidelines that DST sponsor has on, or is he basically just has that trust and he can do whatever he's outlined in his operating agreement to his investors? That's what he can do essentially, or she. Gotcha. Okay. It's interesting to hear the Amazon distribution center or the ESPN headquarters examples. Those are some, yeah. Or medical office. It's been growing. It's been a big, I don't know what it's looking like at the moment, but I know pre-COVID, that was growing pretty well. So
it was, yes, we saw a lot. We were doing a lot of DST seminars around that time, but usually when you're getting a DST, you're working with a financial planner who's well-versed in Delaware statutory trust, because you're really kind of relying on them and their expertise with these companies and these sponsors out there.
Gotcha. And you are recommending inland?
I like inland real estate. I like inland. Mm-hmm.
Okay.
Pasco is another big one. There's a few. Pasco.
Okay. Gotcha. Good. All right. So some additional options though, if your exchange is possibly going to be a failure, if you're not able to line all that stuff up and you want to save it without having to pay that big 40% hit, you can put it into a DST.
Yes, it can be a great fail safe. So a way so that you don't fail your exchange and you've got something to go into. Again, you have to identify that property. So it is going to take up space on your identification form. But it also can work really nicely in a boot situation. So say you're selling for $1 million, all cash, you don't have a mortgage payoff. You find a really great property with you, Hal, for $800,000. Client has $200,000 remaining. They can put that $200,000 into the DST.
Ah, there you go.
So that's really great. The other thing, the reason why I really like them is because if you have debt that you're trying to replace in an exchange because you have a payoff of a mortgage, the DSTs have properties that they'll carry that have existing debt on them, where you basically can assume that debt, and it's non-recourse debt to the client, meaning as long as they're a qualified investor. With DSTs, that is the caveat. You've got to be a qualified investor, and meaning you have to have a certain net worth.
Like an IRS designated accredited investor.
Accredited investor.
Over $250,000 in income and greater than $1 million net worth.
$1 million in assets, right? Not including their primary residence. So. Yep, you got to be accredited, but if you are, you can assume a portion of that debt that it doesn't show up on your books. You don't have to qualify for it in the sense of a mortgage, and then you're able to replace that debt, which can be really powerful in an exchange.
So then you are able to, when you say assume it, you mean like you can essentially become the creditor?
No, the DST companies will go in and purchase those properties first, and they will acquire properties that have some debt on them. Okay. And then they let the investors come in and basically acquire a portion of that debt.
I see. And so whenever the owner is paying back, that becomes part of the returns for the investor.
It does.
Yeah. Fascinating. Excellent. Well, this has been really, really good, Tiffany.
A lot of information. Woo! Again, I'm not a CPA or an attorney. I can't give specific tax guidance or advice.
No, it's no worries. It's been very, very helpful. And so Tiffany Davies is you're going to be my go-to now for any 1031 exchanges that I have. But if you have any questions, if you've watched this video and you want to learn more about this, Tiffany can be reached. That's your number, right? 387-4140.
That's my number right there. Yes.
Yeah. So reach out to her just like I did. And I actually found her on Google. So
awesome.
Yeah.
Love it.
And then your classes with your IXP or your company, you guys do seminars? Are they webinars, classes? What do you guys do? And
we do. With us, there's different stuff. If you get onto our website, IPX1031.com. So that's I investment P Paul X X-ray 1031.com. You get on there, we've got where you can sign up with our monthly webinars. Those are done by our attorneys. So that's you get just really good information. They're short, they're fairly brief, and they're covering topics that are really relevant right now in 1031 exchange. And every once in a while, he'll do a basics class or an advanced class. But here locally, we're offering, a lot of webinars, mainly through our title company partners.
Okay.
So the title and escrow companies are putting those together. I'm always available to do them if you want to put a group together. But I'm available just for a call, and we can set up a Zoom call or something like this for anybody who's interested. But
excellent.
Yeah, we're usually teaching realtors just like yourself out there, giving them a lot of information to make them dangerous.
Yeah, I just have you on speed dial. That's my
That's right. Thank you.
Fantastic. Well, Tiffany, it's been a real pleasure, and thank you again for joining us. And we wish you guys the best. For all of you watching the Hawaii Real Estate Roundup, thank you again. Again, my name is Hal Wilkerson. This is Tiffany Davies. If you have any 1031 exchanges or questions, reach out to her. And again, I'm your guy. If you need any real estate help here in the islands, I'd be happy to help you. All right. Hey, thanks so much. Tiffany, you take care and talk to you next time.
Thank
Bye-bye.
you.